Okay, welcome back, everybody. Today is Monday, January 27th. This is our governmental not-for-profit accounting course. We left off in Chapter 2 on last Friday. I believe the last section that we hit was the statement of changes in fiduciary net position for the fiduciary funds is the last thing that we were covering. Oh, sorry. I do this every time in my 8 a.m. class. I either turn the TV on and don't plug into the system, or I just plug into the system and don't turn the TV on. So I apologize. Usually I'm awake and have everything going by my 10 class, but I apologize. So that better? All right. So like I said before, last Friday we left off with the financial statements on the fund basis statements. The last one we touched was the statement of changes in fiduciary net position for that of the fiduciary funds. Before we move on, is everyone okay with the content we've covered so far? And I want to say one other thing too before we get into this. I'm sorry. The homework, and I should have told people this prior to homework 1 being turned in. I know it was probably people were probably wigging out. I actually just checked my email, got an email from our other student that had a question on the homework and concerns to the CAFRE. The first 6 questions that related to it. The answers can vary depending on which CAFRE you use. So really, there's no wrong answer unless you just pull from the wrong thing. So really, on that part, I'm going to go through and look at how the answers that were answered, because I haven't graded it yet, and see if it looks as if it was pulled. And I'm going to be light on grading it, because what I should have done is assigned a certain CAFRE, and I was unaware of that. But so I do apologize. That's my mistake. So don't worry about having any poor grades on your first homework because of that. So they just wanted to point that out to there. So no worries on that. And moving forward, hopefully I'll catch that next time before that's an issue. So I do apologize if there was any misunderstanding there. But so with that being said, we'll go ahead and move in to the notes to the financial statement now. Obviously, notes are an essential part of the financial statements. It's not considered to be GAAP without them. So you have to have the notes. Really, the notes are so important because if you think about it, within the financial statement, it's mainly numbers, right? That's what we're seeing. We see the elements are listed and what funds they belong in, or assets, liabilities, so on and so forth. But a lot of times, that can't display or depict the whole picture of what's truly going on within an entity or an organization. So we have to have these notes that go along with the financial statements to explain to the readers the other information that it is needed to help it to truly understand the financial statements. So the first note is going to be called the Summary of Significant Accounting Policies. It's going to explain which funds use the accrual basis of accounting and which uses the modified accrual. Whenever a choice is made between an approach, it's going to tell which approach was chosen and why they chose it, and explains obviously what's included in the financial statements. The book goes on to tell a little bit of different summary of significant accounting policies. I'm not going to get really into them, but if you read chapter 2, it's a more exhaustive list or a more detailed list there of what the summary of significant accounting policies could include. So a little more on the notes. It could have a description of the cash deposits with financial institutions, investments, contingent liabilities, encumbrances outstanding, effects of events subsequent to the date of the financial statement. So pretty much just all this other stuff that needs to be included here. I just wanted to read off a few things that the book says, so we know what to expect out of there. So pretty much same thing with notes that we're used to seeing in the commercial business sector of accounting. And if you do recall that a GASB does require RSI, which is required supplementary information. The major RSI items, we know management discussion and analysis, which is the MD&A, and we know that is preceding the financial section. That's the first thing we're going to see in this CAFRE. Budgetary comparison schedule, if you recall, this is going to be for the general fund and major special revenue funds, for which there is a budget in place by law. There has to be the budgetary comparison schedule. We'll take a look at one of those here in a few minutes. Information about infrastructure assets if modified approach is used. The modified approach All that is they're expensing the maintenance on the capital assets as opposed to carrying a contra account, and they have to keep a chart showing like with the level of the fixed assets, the level of what the quality of those assets are. So it's just a modified approach to accounting for fixed assets, because we know fixed assets usually are carried cost less accumulated depreciation, right? Because we have the asset account that is right next to it with the contra asset account of the accumulated depreciation. So we know that that's how that's carried, but the infrastructure assets and modified approach is just expensing it as opposed to carrying it as a contra account. We'll look at an example of that as well. We have an example of the notes and stuff, which is obviously being pulled directly from Chapter 2, which we'll look at. Information about defined benefit pension plans. So we need to have information in the notes about those investments that are being carried for that pension plan. Whatever the PBO is, projected benefit obligation, or whatever, if it's overfunded, underfunded, or whatever the different aspects of the pension plan that the readers need to be aware of. And schedules for external risk pools. So these are some things that we'll see on the required supplementary information. So the budgetary comparison schedule, this schedule actually shows the original budget and the final revised budget after the revisions have been made throughout the year to it. So we have the original one and the final revised one. And the variance column is going to be useful but optional, which the variance is going to be the difference from the final results into what it actually what the actual budget was, the revised budget. The actual figures may not be the same as those shown in the statement of revenues and expenditures, and it's important that the actual column should reflect the basis of accounting that is used for the actual, that is assumed in the actual budget. It needs to show a reconciliation when the budget basis is not the same as that of the fund statements. So obviously same thing, because we know there's going to be differences between the different bases of accounting. There are different items that are accounted for differently. And then the last part here is just combining an individual fund information. It says a complete CAFRE will provide additional details beyond the main statements. Any columns such as non-major funds, which is obviously a total of just all the non-major funds being put into that column. Remember we discussed that if it doesn't meet the 10%, 5% threshold, it's a non-major fund. Well, a lot of times you need to have a combining statement of what just the makeup of what each individual fund is. So you'll have like the actual compilation of all those non-major funds on the actual statement itself, and then the combining schedule of those individual funds will be attached, showing just each individual fund of what makes up that non-major column. So that's pretty much what those combining statements are. Pretty simple, pretty straightforward. And then it even says that some individual funds may be broken down into more detail than on combining statements. And it says here an example is just to show more details of revenues or expenditures for some critical funds. So if they just really want to point out some certain aspects of some really critical funds that they feel is really critical and important. So we picked up with the notes here. So let's just go through a couple little things here. I don't know why I just completely lost my photo here. Are they all going to disappear on me? No. Well. Okay, so here we see the summary of significant accounting policies. This is just going to be a little excerpt. I'm not really going into any detail. It's just going to show what their significant accounting policies are. You can see at the top of the first statement there how the city size is and the population and the range of services that the city provides, and the financial statements prepared in accordance with accounting principles, with GAAP, with GASB, Governmental Accounting Standards Board. So stuff of that sort. Telling about the financial reporting entity. Remember, we have to describe the component units that has to be included in it, and what determines whether it's part of that entity. So stuff of that sort. And it's right here we can see the notes are usually about 20 pages or more. So it's just, obviously notes are really important. We know that from our commercial business accounting classes as well. Notes are definitely required. because you have to know what type of cost flow assumptions for inventory is one of the other ones, and for business sector and stuff of that sort, whether stuff containing capital or operating leases and stuff of that sort. If you, I'm sure you probably recall some of those significant accounting policies that has to be displayed. So that's an example of the notes. Just it's very similar to what we would see in the commercial industry. Just making sure that the reader understands the statements. This right here, when we talked about the modified approach, if you recall, on accounting for fixed assets, it's not going to zoom in. Oh well. So this is an example right here of one of those documents, or one of the sheets that has to be maintained, the schedule of the fixed assets, if the city chooses to use the modified approach, because it's a choice. They can either just depreciate them or expense the repairs. So if we see here at the very top, the City of Salem condition rating of city street system. So this is pertaining only to the city street system, right? For fiscal years 2014 through 2017, we can see that right below here, the percentage of the streets conditions. So excellent to good, there was 35%, fair 26%, and poor to substandard of 39%. If we look to the right, the fiscal years 2018 through 2020, we can see that the percentages increased. They've obviously done some major repairs there, because it went from 35% to 85% for excellent to good, fair 26 to 13, and poor to standard 39 down to 2. So they all moved in the way in which they should have. Now, if we look at the bottom half of the schedule here, so comparison of needed to actual maintenance expenditures for city street system. So obviously we can see here at the end of 17, it started increasing to better position or better conditions here from 18 to 20. So we can see obviously there's been some spending here throughout these fiscal periods here. On the top line here for each year, it shows the amount needed to maintain, the dollar amount needed to maintain the streets into an acceptable condition, and the actual amount expended on it in each of those years, the line under there. And as we can see in each of those, we barely missed what the needed amount to actually maintain the roads from what was actually expended. And it says at the bottom, the city has an ongoing street rehabilitation program funded in the general fund that is intended to improve the condition rating among the city streets. The rehabilitation program is formulated based on deficiencies identified as part of the asset management system. So that's just an example. If the modified approach is used, they have to show how much they actually expended on it, how much was needed to actually maintain it, and then show the actual condition rating of the street. So that makes sense. So instead of actually having a schedule of a depreciation schedule of fixed assets, they just have a conditioning schedule, because they choose to expense it as opposed to carry it in a contra account. Make sense? Okay. And a lot of governments will actually go about it this way. So that's what the modified approach means, pretty much. Pretty simple. So just have to make sure you have this sheet that attaches along with it to show that they're actually maintaining them to that certain level. Last thing here. Hopefully this will let me increase the size of it a little bit. I don't think it's going to let me. It's really blurry, but pretty much just, I know you can't really see it. It's pretty blurry. This is the budget comparison schedule. And pretty much we can see the items listed on the left here. Here, this is the budgeted amounts right here. This is the original amount. This is the final budget. Remember, because we said at the beginning they set a budget, then they would make revisions throughout the year. So the second column is going to be the final revised budget. And this is what was actually spent. And this is just the variance, the difference between this column and this column. And these are obviously just per line item right here. I'm sorry it's blurry here, but that gives you the gist of what it is. And once again, this is the figure 216 in chapter 2 on page 45, if anyone wanted to really look at the actual clear picture there. But long and short, that's what it is. You got the budgeted amounts, the original and the final, on these left two columns, and the right two columns. The third column is going to be the actual amount, and then the variance, which is optional. This is the optional one, doesn't have to be shown, which is helpful, is the difference between column 2 and 3, which is the difference between the final revised budget and the actual amount. Pretty straightforward, right? Okay, well that wraps up chapter 2 for us, dealing with the overview of the financial reporting for state and local governments. Remember that chapters 2 for Connect assignments. Again, chapter 2. So yeah, chapter 2 Connect assignments will be due at the end of the week. It'll be due this Sunday at 11:59 p.m. You've got the little quiz and homework and smart books assignments to do on that. So if everyone would please get in there and make sure they get those assignments completed on time. And as always, if you have any questions, please ask me, and I'll get back to you as soon as possible with it. Next, we're going to move on to chapter 3. Does anyone have any questions before we move on to chapter 3 with the stuff we've covered? You okay? Okay, so next we'll move on to chapter 3. So chapter 3 is dealing with the modified accrual accounting system. It also includes the role of the fund balances and budgetary authority. So now we've taken a look with the first two chapters. First chapter and second chapter has pretty much given us an overview of the course and of how governments operate and the main differences between the commercial sector accounting system and between FASB and GASB pretty much. We got into the funds, little bit on the difference basis of modified accrual versus accrual, and we had an overview of what the CAFRE is made up, the Comprehensive Annual Financial Report's made up of, and the different financial statements and stuff that's included within that report. Now we're going to kind of switch focus and start getting into the details of the funds. So obviously we're going to be starting on this chapter with the modified accrual accounting and including the role of fund balances and budgetary authority. Okay, some of our learning objectives is going to be to describe the basic accounts used by governmental funds. We're going to have nominal accounts and permanent accounts, just like we have in our other type of accounting that we're used to, stuff that's closed at end of the accounting period and stuff accounts that are not closed. So same thing we're used to with the closing process, although it is just a little bit of differences there. Identify the recognition criteria for revenues and expenditures under modified accrual basis. Remember, they differ from that of accrual basis. Remember, with accrual basis, it's when it's earned. So that's going to be a difference there. On this, it's going to be when it's measurable and available. We'll get into the rules with that later. Apply fund balance classifications for governmental funds, because remember we had fund balance classifications, meaning the extent of constraints placed upon these funds. So whether it's non-spendable, committed, or restricted, stuff of that sort, we'll get into those. And then we're going to prepare some journal entries for the expenditure cycle using both budgetary and activity accounts. Those are some of our learning objectives for the chapter here. So we'll start off with modified accrual accounting. Modified accrual basis is the distinct system of accounting. It contains some elements that are not going to be seen anywhere else in financial statements. These two elements are expenditures and fund balances. Expenditures obviously differ from expenses, and we'll get into that a little more as we get through the class. Fund balances is a lot like net position, but it's used as a fund balance only for governmental funds. So fund balance is like net position or equity for the most part, but we have to look at it as fund balances for the purposes of dealing with funds. Revenues appear in financial statements of accrual and modified accrual accounting, or modified accrual and accrual funds. Revenues follow different recognition criteria between the two bases, though. And obviously, as we said before, there are no expenses in modified accrual funds, only expenditures. So a little bit with some account structure. So these are permanent accounts. So, in other words, accounts that are not closed at the year end. So, these are going to be like balance sheet accounts. Those are going to be the ones that are permanent accounts. Because if you recall, the balance sheet is the position at a point in time. Operational accounts is going to be stuff that's closed, because operational accounts is what is doing the interperiod or intra-period activity that is closed, and then ultimately closed and end up on our balance sheet with the permanent accounts. So same system as we're used to from the commercial business. So right here, balance sheet. Obviously, we know we have our assets, which are first, which obviously cash equivalents, investments, receivables, which would be taxes receivable, accounts receivable, or dues from other governments, supplies, inventory, restricted assets. And remember, the other part of the assets with dealing with these funds is going to be your deferred outflows of resources. We talked about that a little bit on Friday. Liabilities, accounts payable, accrued liabilities. The deferred inflows of resources, which are our deferred revenues, which is going to be mostly taxes that are going to be receivable. And then fund balances. Remember that from our net position or equity section of these funds on the balance sheet. And we have the 5 categories of non-spendable, restricted, committed, assigned, and unassigned. So those are the different layers of constraints that are going to be put on the fund balances. So obviously, fund balance is going to be the difference in assets and deferred outflows of resources over liabilities and deferred inflows of resources. That gives us our fund balance. And then the fund balance is going to be broken down into those 5 categories of what the constraints are on those available sources for future spending. Remember, these accounts are not closed at year end. More with account structure, these are nominal accounts, so accounts that are closed at year end, more of the activity accounts. Okay, so they're budgetary accounts and financial statement activity accounts. We'll start with the budgetary accounts on the left-hand side here. So the budgetary accounts that are used in governmental accounting is going to be estimated revenues. Then we're going to have appropriations, which is what's going to be expected to be expended during that period. Obviously, estimated revenues is what we expect to bring in. Estimated other financing sources is what we expect to be bringing in as well. And then estimated other financing uses is what we are expecting to use as well. So that's actually how we're going to go about setting the budget, and we'll actually go through that later. But the only part that's missing, if we would actually set the budget, so if we were setting a budget, it would be a debit of estimated revenues, a debit of estimated other financing sources, because that's what we expect coming in, right? And then it would be a credit to appropriations, and then a credit to other financing uses. And then the difference between the debits and credits is going to be a plug of fund balance. If it's a credit, obviously, that means it's in the plus, and if it's a debit, that means it's in the negative. And if you notice here how I said that estimated revenues and estimated other financing sources are going to be debited, it's a little bit different than on our commercial. Usually revenues are credited, but in this case, it's what we're expected to receive as of the asset form, so it's going to be as a debit. So it's a little different, but once we get into actually setting a budget, and we'll get some practice setting a budget and doing some entries, you'll see. I just wanted to point out that the budgetary accounts up there, that is what's used actually when setting the annual budget. Encumbrances is another part of budgetary accounts. We'll get into encumbrances in a little bit, but the entry for when we encumber some funds is going to be a debit to encumbrances for whatever the specific reason is, and then a credit to budgetary fund balance reserved for encumbrances. And we'll get into what encumbrances are here shortly. Then next we have the activity accounts, which is from the financial statement. Revenues, obviously tax revenues, charges for services, expenditures. If you remember, revenues are recorded by what?
Revenues are recorded by debit.
By source. Remember, they're recorded by source. Sorry, I know that was yeah. Estimated revenues are recorded by debit. You're right. But remember, revenues are recorded on the financials by source. Remember, of the source of where we're getting that money. And then expenditures. Remember, current outlays are represented by function. Remember, whatever the current outlay is by function, whether it be for parks or for whatever the streets or whatever it might be. Capital outlay wouldn't be for streets because that would be capital outlay. For fixed assets and debt service for past spending, that's for expenditures. Other financing sources, which is going to be transfers in and debt proceeds. If you recall, that's the only time we can use other financing sources, and other financing uses is only going to be transfers out from funds. So that's an example of the accounts that are closed at year end. This is just an overview, so don't really beat yourself up with it too much. Although these two charts, sorry, I'm got the hiccups. These two charts here, very important, slides 5 and 6 with the nominal accounts and the permanent accounts. Try to really learn them now if you can, because it'll help a lot once again moving forward in the course. But just main thing is just know that it operates a lot like we're used to seeing in commercial sector. Other than that, than the role of the budget, but we'll have plenty of practice with that. Assets and liabilities. So the modified accrual funds are going to use the current financial resource measurement focus. So let's just really think about that for a second. Modified accrual funds use the current financial resource measurement focus. So they're only focused on what is current. Okay, so therefore, if it's only the current financial resource measurement focus in these funds, we're only concerned with what's current. We don't care about anything long term. What makes something current or long term?
Well, time.
Right, it's time. If it's current, it's expected to be used within a year, within the calendar year, or within the operating cycle. Remember, if you recall that. So that's what's current, and anything that's not current is by default. It falls without that year, right? So obviously, the only thing we're really going to be focused on is what current financial resources that we're measuring and focusing on. So let the names help you on, just like the funds nature is going to be used for that particular purpose, like capital projects, money for capital projects. Modified accrual, current financial resource, you're only worried about current stuff, nothing long term. So in saying that, the assets represent cash and assets that may be expected to be converted into cash in the normal course of operations. Excludes long-term capital assets. So the only assets we're going to see in these funds is assets or cash that's expected to be used within that accounting period, within that year, right? So it's only current stuff. So we're not going to see any buildings or property or anything reported in these funds. It's only going to be current stuff like supplies, inventory, and stuff of that sort. Similarly, it says these funds report only those liabilities which will be settled with current financial resources. So it excludes long-term liabilities. You're not going to have any bonds payable or any notes payable. You're not going to see any of that within these statements. Okay, that's not going to be shown there. That's on the government-wide. Okay, that's where you're going to find your long-term liabilities. So modified accrual, current financial resource measurement focus, only concerned with current assets and current liabilities. Okay, that's it. Fund balance. The account category fund balance is unique to governmental funds. Okay, fund balance serves a purpose similar to retained earnings, and that at the end of the operational periods, your operational accounts, the activity accounts that we went into, the revenues and expenditures and all that, is going to be closed to fund balance instead of retained earnings. So you know how at the end of your accounting periods, when you're closing the monthly books or yearly books, net income is closed to retained earnings, right? Because retained earnings is a component of what?
Retained earnings is a component of
stockholders' equity. Right. So that's why it's closed. Because remember, what the activity of it is closed to retained earnings, and retained earnings is equity. So obviously, if a company has net income in a period, the equity of the company is going to go up. It's going to be worth more. If it has a net loss, it's still closed to retained earnings, but it's going to bring your equity down because the retained earnings are going to be depleted. So it makes sense. Same thing here. This with governmental funds, we're dealing with the fund balance. So whatever that fund balance is, whatever the activity accounts are going on at the end of that period, we're going to just plug it in close it in the fund balance. Makes sense? So it's like retained earnings in the aspect of how the activity accounts are closed to fund balance, and it's done the same way that we see in commercial type. So a better interpretation of fund balance, since only current financial resources and claims against those resources are recognized in these funds, the difference between assets and liabilities, which is fund balance, which is usually equity, right? because usually assets less liabilities equals equity, right? But in this case, it's fund balance for governmental purposes. And that's going to represent the net resources of the fund that are currently available for future spending. So obviously, if we're looking in that fund and we see the assets, plus your deferred outflows of resources minus your liabilities, plus your deferred inflows of liabilities or deferred inflows of resources, then whatever that is, the difference is going to be your fund balance, right? And that's going to represent what is available to be spent. But then it says here, however, even the current financial resources vary based upon constraints placed upon it. So that's getting into the non-spendable, committed, restricted, committed, and all that other stuff, unassigned and assigned. So that's what's going to get broken down into. But the main thing is the difference between your assets, deferred outflows, liabilities, deferred inflows, fund balance, and just know that's the same as equity with the commercial. What's available to the owners or the government, but for the governmental purposes, it's there's restrictions placed on it. So that's pretty much all we're getting to. That makes sense? Okay, so the reporting of fund balances. The objective of fund balance classification is to provide information regarding the availability of net resources in the fund. So obviously, if the fund is non-spendable, it's not available, right? So the reporting of fund balances within fund balances is to determine what's available and what's not. So what's earmarked for certain purposes. So obviously users want to know whether the use of amounts reported in governmental funds is constrained and how binding those constraints are, right? So this is a way to know how much bound the government is with whatever resources they have left over. So fund balances, financial statements. Fund balance appears only in fund basis statements of the governmental type funds. So fund balance is only in governmental type funds, right? Remember, there's 5 of them. Does not affect the reporting of net position by proprietary or fiduciary funds. So those 2 other types of funds are unaffected. And it also does not affect reporting of net position of governmental activities in the government-wide statements. So it doesn't affect anything here. Fund balances summary. Fund balances of governmental type funds are reported within 5 categories. Obviously, we can see here the 5 categories. The first, non-spendable, can't be spent, right? A good example of that is your corpus of a debt service fund, which is the principal. Is another word, corpus, principal, same thing. That cannot ever be spent. So that's labeled as non-spendable. Restricted, that's going to be our next one. Obviously, restricted one, that's going to be if people outside impose restrictions on us, like donors and debt covenants, stuff of that sort. Committed, those are going to be in the middle here. So committed funds, those are going to be within the government. The highest level of authority is earmarked those funds. So that's done within the government. Assigned, that's merely just assigning the funds. So they've just put a verbal intent. They've just intended for something to be assigned to that purpose. And then unassigned, okay? And we'll get into these a little more in detail, but those are the 5 categories. Makes sense? And that's the order of the constraint. Obviously, non-spendable, can't touch it. And then with the spendable funds, which is the last 4 categories, those are the different constraints. Obviously, with restricted being the highest constraint and unassigned being the least constraint. Okay, so it's a 2-step process in determining the fund balance, whether it's non-spendable or spendable. So the first step, obviously, we know when we recalled from chapter 2, when we looked at these balance sheets for the governmental funds and the fund balance position. Remember, it started with non-spendable, then committed. If you recall the different breakdown of the fund balance. So obviously, in this 2-step process, we're going to be starting with non-spendable resources, right? Because that's the first one that's listed in there, because we're actually building these financials, right? We're going to actually building what's presented on these financial statements. So the first step that we want to do is identify those fund resources that are non-spendable. So non-spendable resources are most commonly your inventories and prepaid items. It also includes assets held for sale and long-term receivables. So those are going to be your main example of non-spendable resources, inventories and prepaid items. And also, as we just discussed, the principal or the corpus of a permanent fund. Okay. So that's the first thing. Identify the funds, resources that are non-spendable. Okay, step 2. Then we got to determine what the spendable resources are. Obviously, if it's not non-spendable, then it's spendable. So all remaining net resources of a fund after removing those determined to be non-spendable are obviously spendable. If it's not one, it's got to be the other. But then if it is spendable, like I said, there's 4 classifications in which they can fall under. They have to be further classified according to the nature of any constraints that is imposed on their use, using a hierarchy of constraints. So the constraints could be placed by donors or by law or debt covenants, like I said before, based upon the various constraints. So 2-step process. First, determine if it's non-spendable. What's some good examples of non-spendable resources?
Well, the corpus and the principal.
Of what fund?
Of, like fiduciary.
No, that's a governmental. But think about permanent fund, can't be touched. The corpus permanently intact, permanent. That corpus is permanent. So that's one example of a non-spendable resource, the corpus of the permanent fund, and then
inventories or prepaid items.
Awesome. Yep, that's your non-spendable ones. Inventories, prepaids, and then you've got your now my head just went blank. Inventories, help me out now. The corpus of your permanent account. Sorry. So those are going to be your non-spendable. So obviously, if it doesn't fall into one of those categories, you move on to spendable, right? And then we got these different constraints coming into play, right? So GASB's fund balances constraint hierarchy, as we said before, the four categories of spendable funds is restricted funds, then committed funds, assigned funds, then unassigned funds. And you'll see on the right it says most constrained to the least constrained. So obviously the most constrained funds will be the restricted funds, and then no constraint would be the unassigned, obviously. And the reason why it says general fund in parentheses there at the bottom is because unassigned funds, like any positive unassigned fund balance, has to be in the general fund. No other governmental funds can assign a positive fund balance to unassigned fund balance in any of the other capital projects, special revenue, or the debt service or permanent. It can't be. The assigned funds is the last category for there. So if there is any positive money left over in any of those other funds other than a general, they assign it. Just because it's supposed to, and the purpose of it is because if it's in a capital projects or special revenue or permanent or debt service, it's supposed to be there for one of those specific purposes which the fund is labeled for. So that's why it can't have any unassigned funds, because therefore it'd have to go back to the general fund, because the general fund is what's used for general operational purposes. So does that make sense why any unassigned balance has to be in the general fund? So really, unassigned funds is only relative to the general fund, right? So assigned funds is going to be your category right there for your other 4 governmental funds. So by nature, if you have assigned funds in the general fund, it's going to be more specifically tailored to what that need is than it is in the other funds, because they're trying to just keep that money in those funds and assigning it so it doesn't look like it's unassigned. Make sense? Okay. Okay, so let's start off at the top of the constraint hierarchy with restricted funds. So the restricted funds, these constraints are going to be placed on the use of resources by externally imposed parties. So it could be a bank, a debt covenant. You can't fall below a certain debt covenant in order, or they'll call your debt the current. Granting agencies, so granting agencies can give grants, but you can't spend it, obviously, besides spend it on anything, obviously, but besides what the grant was the purpose of the grant was for. Contributors or other governments, obviously contributors could be just anyone making a contribution. So if myself or yourself made a contribution to a permanent fund and said, we're going to put $100,000 in there, and it's going to be used to give scholarships to students that have a 3.5 average GPA or higher from Bluefield State College, and only the interest can be used for that purpose of scholarships. The principal has to be put in place. Does that make sense to give it a good example of why permanent funds? It's like an endowment pretty much. You know what I mean? The corpus can't be touched. So you're just earning off that principle. So pretty much. But back to, got off track there. Restricted funds, these are going to be replaced. The constraints are placed by external parties pretty much. Okay, and like I said, it could be debt covenant, or it could be imposed by law, constitutionally, or by legislation. And it says here, i.e., enforceable requirement that resources be used for specified purposes. So externally imposed or by law. Okay, but either way, it's going to become by external forces. A little more on restricted funds. This is dealing with the difference between governmental funds and government-wide funds. In general, the definition of restricted fund balance is nearly identical of that of restricted net position in the government-wide statements. Because if you remember, governmental funds use fund balance, right? Government-wide statements and proprietary and fiduciary statements, they use net position, right? The term net position. Fund balance is only within those 5 governmental funds, right? So what it's saying here, restricted fund balance, which is the highest level of constraint, right? Imposed externally by law or by people, debt covenants, whatever it might be, right? Restricted highest purpose. So restricted fund balance in the governmental funds, what they're saying here, if you're looking at the restricted fund balance on the governmental fund balance sheet, and then you're looking at the restricted net position in the government-wide statement of net position, it's going to be the same thing pretty much, even though they have different terms. The only exception is the permanent fund principle, which we just talked about, is labeled as non-spendable on the governmental funds, right? So we can see here, fund basis, governmental fund balance sheet, restricted fund balance, because the corpus is considered to be restricted, right, for governmental fund purposes. On the government-wide statements, it's just going to be non-spendable, or restricted, restricted. It's just going to be in a different category. But it's the same. It's just labeled differently, right? Only difference. But it's pretty much the same thing. That's the only difference there is that the corpus of the permanent fund is labeled in a different category. So that's the only variance there. So pretty much they relate to one another. All right, so good on the restricted constraint. Next is the committed constraint. So committed funds are going to be the committed constraint is going to be placed on the use of resource by the formal action of the government's highest level of decision-making authority. So committed funds, that's the third level right there. Highest level decision-making authority within the actual government itself. And GASB specifically identifies contractual obligations as one form of committed resources. So if our government, you have our own government, and we have contracted with like Swope Construction or a construction firm to build something with us, if we're under a contractual obligation with them, then whatever that contract calls for, then we need to assign that as committed. That's specifically, GASB specifically says contractual obligations should be deemed committed. So it makes sense. That's a good example of what's committed. Or if the government just says we're going to commit this, like the highest person in the government says we're going to commit this for X purpose, then that should be committed. Okay. Rainy day funds. The reason why we're dealing with this with the committed part is because that's usually the classification where it'll fall into. Pretty much. GASB gives guidance on budget stabilization or rainy day funds. They have to meet certain criteria and be classified as committed or less commonly restricted if imposed externally by law. Pretty much what these are is just for cases of emergencies or if like times of economic downturn, pretty much just it's a safety net. Government has a rainy day fund, and GASB says that it's most likely going to be in committed or less likely externally imposed by law. They could also be in just unassigned, and the bottom part of this gets to it. If it's going to be committed, rainy day funds are classified as committed only if they are created by a resolution of ordinance. And that ordinance has to identify specific circumstances under which the resources may be expended. So pretty much saying it has to be this much of a catastrophic event at this much of a financial burden in order to tap into that rainy day fund instead of something to differentiate it from just a regular raining flood that might have just flooded out a building or two. So it can't just be these normal events. It has to be something that is specific of what causes it and a cost threshold for it to be classified as committed. If it's not, it's just going to be assigned. Okay, but the main part here is just rainy day funds. Just to know that governments have them, and it's usually either going to be an unassigned, committed, or less likely, restricted. Sorry, it's going blank here. So we're good on rainy day funds there. Now, next is assigned funds. The government has an expressed intent to use resources for specific purposes. So obviously, if they're assigned, then they can earmark them towards different purposes a lot easier, right? Obviously, as you can see, as the constraints go down, they could earmark assigned funds too, or committed funds too, because it's imposed by the government if they decide, the governing body decides to change the earmark. But assigned, it's just an expressed intent. For governmental funds other than the general fund, this is the category for all remaining positive amounts. Remember, I said that earlier, that assigned balances when we were at that hierarchy right here. That assigned, remember, unassigned is it's a residual for just the general fund. None of the other funds can have a positive unassigned fund balance. So the assigned fund balance is what this is talking about right here. That's the remaining all positive amounts within that fund have to be assigned. That's the last step there. And for the general fund, assignment conveys a narrower intended use than the general purpose of the government. So obviously, if there's assigned funds within a general fund, then it's going to be for a more specific purpose than if it is in your debt service or capital outlay or capital projects, whatever it might be. Because we know they're just more so doing that to hold on to the funds. And then the general fund, we know it would be in the unassigned if it really wasn't assigned anything. So that's assigned funds. Lastly, unassigned funds. This is just simply the residual classification of the general fund. So once again, unassigned funds, positive balances are only found in the general fund. Only the general fund can report a positive unassigned fund balance. For other governmental funds, this is used only for a negative fund balance and any of the other previous three constraint categories. So that's where we're going to stop with today, the different levels of constraints from the GASB hierarchy. Any questions on what we've covered so far? Pretty straightforward on it. Okay. Well, I'd say that we're probably going to be the rest of this week in this chapter, most certainly. We might cover the content of the slides on Wednesday, maybe not. There's a lot. We only got the slide 21 today. There's 62 slides. I don't know if anyone's looked at them yet. But they do move. Some of them move kind of quickly. But I would like to go through some examples before we move on from this chapter from the appendix, because it shows some detailed budgetary entries, and we'll discuss it a little bit. I think that'll give some good insight when approaching the homework. So no questions so far on anything. Everything good? Okay, well, that's it for today. And then, like I said, we'll continue on with chapter 3 on Wednesday, and we'll start off on how we actually go about deciphering and building that, the fund balance section, non-spendable and everything. We'll go through those steps of what we just went through with some examples on a statement here in the notes. So that's all I have for everyone. I hope everyone has a good day, and I appreciate your time, and I will see everyone.